Good morning. My name is Hindell Grossman. I'm a divorce attorney and the owner of a law firm called Grossman and Associates in Newton. Welcome to Inside Divorce, a podcast series on divorce-related issues. Today I'm sitting with Brad Avergon, a senior loan officer at loanDepot, and we're going to talk about financing real estate and the best way to finance real estate during and after a divorce.
You know, I find it's interesting. I find a lot of people having gone through a divorce, it's obviously a very emotional process. Having a fixed mortgage payment is somewhat comforting. Even though you think I'm going to be out of this house in 7 years, at least you don't feel like, oh my gosh, my payment's going to change at the end of 7 years. It could go up, and what am I going to do? I don't know.
So good morning, Brad.
Good morning. Thank you.
Today we're going to talk about the industry of mortgage financing with Brad, who is a seasoned mortgage professional whose mortgage knowledge and exceptional customer service has allowed him to develop a reputation as one of the local leaders in mortgage lending services. Brad brings a unique perspective to the real estate industry. He began his career as a real estate agent and then moved on to his passion, which is real estate finance. He started as a loan officer for one of the leading banks in Massachusetts and now works 28 years later for one of the top privately held mortgage lenders in Massachusetts called loanDepot. He's licensed in Massachusetts, in Rhode Island, and in New Hampshire. He helps people refinance properties, purchase properties, and a variety of other financing options related to real estate. Now, Brad's a lot of very valuable information to tell us today about how real estate financing relates to divorce. And we're going to set up a hypothetical situation so that we can talk about how Brad's work would help the people in the divorce scenario. So today we're going to imagine that we're talking about a wife who wants to remain in the marital home with the children, following a divorce. And we're going to imagine that there's a house with $1 million fair market value and that there's a mortgage on that property for $500,000, so that there's equity for $500,000. And so we're going to talk about how that wife might buy out her ex-husband's interest in that house, what the wife would need to do process-wise, and what kind of financial history that she will need, both in her employment, her income, as well as how the child support and the alimony are structured in order to qualify her to do that pursuant to the divorce. So Brad, first, would you walk us through what the process is if this wife were to come to you and apply for financing in order to buy out her husband's interest in the house?
Sure. So oftentimes people come to me, they're thinking about getting divorced. They're not quite there yet. And so the process would be, we would look at, as a pre-qualification standpoint, we would look at their income, their assets, and their liabilities. Sometimes when you're dealing with the wife in this particular case, some of the liabilities, for example, the mortgage may or may not be in both names. So that's something we're going to need to be able to get a little bit of a history on, make sure that mortgage was paid on time. But we're also going to be looking at the income to see if she was working. And if she hasn't been working recently, if she was a stay-at-home mom, as may be the case in this, we'll go back to see how many years she was working for before she left the workplace, and is she planning on going back into it? So we'll evaluate kind of all of those things to look at.
Okay. So you'll sit with this particular wife and look at her assets and liabilities and her work history. Mm-hmm. And then you get this information from her. What happens with this information? So
I take a look at it. We look at what's the goal. Is the goal here to just take care of the mortgage, refinance the mortgage? In this particular case, we talked about, I think, her trying to stay in that particular property. So what we would do is evaluate her ability to carry that debt based on her projected cash flow. Okay. So that's the first thing. Because obviously we want to get within somebody's comfort zone. Doesn't matter what all the bankers think. If they are not going to be comfortable with that monthly payment, that's very, very key. And there's a number of ways we can look at that. One way is we can look at the timeline. How long is she going to have to stay in that property? If she just wants to stay in that property long enough to get the kids through high school and maybe college, then maybe we can look at a shorter term product, maybe like an adjustable rate mortgage that's fixed for 7 to 10 years, which may reduce her cash flow, or maybe even an interest only mortgage, where it's fixed for that period of time, but it's interest only. So that's something that we would look at, make sure that she's comfortable with that. I would look at her credit, make sure that her credit scores are where they need to be and that there's no credit issues there. And then again, we would look at that projected income. What is she going to be making? What does she anticipate she's going to be making based on the settlement?
Okay. So under our hypothetical situation, if there's $500,000 worth of equity, then the buyout of her husband, let's say theoretically it's $250,000. So she's got to carry not only the existing mortgage of $500,000, but also an additional $250,000 so that the husband can be bought out of his interest in the house.
That's
right?
correct.
Okay.
That's correct.
And so after you've examined the information you just described, does it go to another part of loanDepot, for example, in order to make a determination of whether she's qualified?
So, well, what happens is I would do the preliminary analysis myself. It would not go to underwriting until we had all of the key pieces to be able to have a loan be underwritten, which would include the divorce decree. It would include an appraisal on the property, establishing that there's value and equity there to tap, and so forth and so on. My evaluation piece, the preliminary part, is I would look at her W-2s, assuming she was working. I would look at the projected income, but I wouldn't put the loan into submission. I wouldn't put it into effect, the application, until we had a final decree, because as I'm sure you can imagine, there's some variations that can happen as far as cash flow and such.
Right.
And the way that that decree is written could also influence how much income we're going to be able to use.
All right. So this wife comes to you and you do a preliminary analysis of whether she'll qualify, but the divorce isn't final. Let's say in our scenario, the divorce isn't final yet.
Right.
So you're really projecting what could happen potentially if certain terms were included in the separation agreement.
That's right.
What you're calling this divorce decree.
Right.
So how would you suggest that divorce agreement is structured so that she can enhance her chances of refinancing?
Well, that's a great question, because a lot of the divorce decrees that I see after the fact are structured in such a manner, while they may be beneficial to the wife in this particular case, they are detrimental when it comes to qualifying for a mortgage. So one of the things that I would suggest is having a minimum fixed income that's going to be coming through, stated very clearly in that divorce decree. As of recent, we've had situations where the ex-wife's income is going to be a percentage of the ex-spouse's income, and it's written as such. The problem with that is underwriting doesn't know where to go with that. They have no way of establishing a bottom line and nothing to kind of hold their hat on.
Because it's not a fixed number.
Because it's not a fixed number, and underwriters are very conservative, and they have to be.
Yeah.
So it's really important that you have that minimum established. And the other thing is, even if that's going to change down the road, there's a 3-year continuance window of income. So if you're going to have a step down of income at any point or a variation, you need to at least have that minimum established for that 3-year period as dictated in that divorce decree, and that will allow me to use that income when qualifying. The other thing is that's really important is timing. There's a minimum period of time that the wife in this particular case must document receipt of that alimony and or any child support income, even if it's dictated in that divorce decree, before we'll be allowed to use it. And that period of time is that 6-month period.
So before it counts for your purposes, for underwriting purposes, is 6 months from the date of the divorce judgment? Is that what you're saying?
That's correct. That's a court-recorded divorce judgment. That's
so it doesn't matter how many months or even years child support or alimony were paid before the divorce judgment for your purposes.
That's correct.
Yeah. Okay. So, because people are very confused sometimes about that durational period before the divorce and whether that counts.
Yeah.
And so it really encourages people to get divorced sooner.
Exactly.
Moves everything up.
Exactly. Well, it's funny how we see things, because oftentimes we'll see a separation that will go on for sometimes years. I have a case right now where people are actually technically still married, and they've been living apart for years. So, and then there's child support going back, but it's not technically child support
for your purposes.
For our purposes, because there's no written formal court judgment. So. That it can be very, very confusing. So it is important that they get divorced sooner, and that they get that document kind of wrapped up, and that they plan accordingly, because obviously we cannot buy out that spouse until that happens. And what's more is you've got to be able to have that cash flow to be able to carry those mortgage payments. What you don't want to do is be in that home for that during that 6-month period and then fall behind even by 30 days. Then when you come to us and all of a sudden it's a problem, so which can trigger all sorts of other things in a divorce decree, like selling the home and things like that.
Yeah, that's often a concern, because I often find, and you probably see this too, is that one spouse takes care of the finances more than the other spouse. And if in our hypothetical it's the wife who hasn't really been that involved in the finances, and the husband's concerned that his credit is going to be affected if suddenly she isn't timely in her mortgage payments when she's responsible for making them.
Yeah.
And
I had a very interesting case recently where the ex-husband was paying the mortgage and deducting it from her alimony and child support, just to make sure that his credit wasn't being impaired.
I see
and
that.
we had to document that.
Yeah, I see that happen a lot. So getting back to the counting of the 6 months from the judgment date. So, often prior to the divorce judgment, which is the final event, there is something called temporary orders. While the divorce case is pending, it's a court order saying that someone will pay alimony and or child support. So that doesn't matter to you, does it? That temporary order.
Right. It's all subject to change until that final document is recorded.
Right. So how do you deal with the variations in people's lives? You touched on that a little bit a minute ago about children emancipate and then the child support may be reduced, or alimony may be for a fixed term now, called the duration. So how does underwriting or you in your preliminary analysis handle that?
Well, the good news is, if I'm speaking with the client early enough, before the divorce decree's been carved out, I can often help at least give some of the knowledge so that you as a divorce attorney can carve it in such a manner that they're able to set it up that they can refinance down the road. Things that might not be, things that are common sense don't always translate into my world.
Right.
So so things such as the 3 years of continuance, stipulating, for example, in the areas of child support, there's an often clause in there that says, should the child go on to college, child support will continue until such and such an age. Other than that, it cuts off at 18. Well, in my world, there's that gray area. Even if they're in college, the question is, will they stay in college? And if they leave college, does that child support drop off there, where we can't count it as income? So if the divorce decree spells out that it goes to age 22 or 23, then that, given that their intention is to go to college, then that will often offset it. We have to take the most conservative approach. So when someone sits with me, I'm going to look at that and make sure that they qualify using underwriting guidelines as a whole. We often fall into the gray area, and I'll do my best to make a case for that. So for example, sometimes I will see a situation where the wife gets an income that's a minimum, but there is a bonus component. The husband may get a bonus, and maybe she gets 50% of that bonus. Assuming we can get some cooperation with the husband, which sometimes we were able to do. I'm often in a position where I'm speaking directly with the ex-husband and can get some of that documentation, because it's in their best interest as well to be taken off of that loan so they can move on with their life.
Yes.
So I can get things such as historical bonuses. If I can see that he's received bonus for the last 2 or 3 years of X amount, and the wife is going to be getting 50% of that, then I can often make a case for underwriting to be able to use that income to help us qualify.
Yeah, okay. You become an advocate for the applicant.
Absolutely. I think that's one of the most enjoyable parts of my job.
Yeah, the historical earnings are important, but sometimes they're very variable, or even if they were consistent in the past, they're inconsistent in the future.
Well, that's where I think that having done this for 30 years, it kind of comes in. I've pretty much seen every possible case you can imagine, from people that before they're divorced all the way through after they've been divorced for a while, and trying to put these pieces together. And there is a little bit of gray that we can try to push, and I can fall back on some things. So.
I imagine one challenging thing is when a child goes to college and the impact on child support, because judges vary a lot on that. Theoretically, child support continues till a child's emancipation, which is graduation from college or into the military or getting married. But for most kids, it's, they go on to college. And there may be a gap year, first of all, after high school, before college. So how is that treated? And then there's some judges that say that child support can, depending on who's paying for the college, that the child support doesn't have to continue at the same levels, particularly if the same person who's paying child support is going to pay the majority of the tuition.
Right.
So it doesn't automatically terminate at 18, but we don't know how long the judge will continue child support, and it depends on the circumstances of each case and who's paying for the college tuition.
Right. And there's often a step down, as you indicated too. And so underwriters will always move to the most conservative point. So they're going to look at that step down. If the child may be graduating this year, but I'm looking at 3 years continuance, they're going to take that step down approach and use that as income.
But how does underwriting assume what the new step down number will be?
If it's not dictated in there, that's a challenge.
Yeah.
They may not even use any of it at all at that point, because they say, well, as you used the perfect example, a gap year. What happens then? They've graduated high school per the strict writing of the divorce decree. That alimony the child support can stop technically. So.
Well, it depends on how it's worded, but not necessarily. It's become pretty common for a gap year these days. So I think there's a general expectation that the child will go to college just a year later. Child support will probably continue, and it depends on whether the child continues to live with one of the parents.
Right.
And is principally dependent on that parent during the gap year, or if the child has their own income, goes off and lives somewhere else and has their own income.
Right.
So many, lives change, right?
Absolutely.
Yeah. And then the other thing that probably impacts your decision is that there's new child support guidelines. They changed in 2013, and they're changing this summer too.
Wow.
So the worksheet, will change the number a little bit. I don't know if it will be higher or lower than it is now, but the calculation will be different.
Yeah, that will be interesting, because we do see all sorts of variations. As I know in your work, you're constantly looking at those things and offsets, and it is interesting. That's for sure. Yeah.
Does underwriting handle child support differently than alimony as far as giving it weight as income?
Alimony. From our standpoint, when we're looking at a tax return, alimony, if there's a historical perspective. So alimony is taxable, so we're going to be able to see that as it comes through. Child support is not. As far as the weight goes, as long as there's 3 years continuance of both, they weight them pretty equally.
3 years meaning in the future. So if you're looking at day one, you have to have certainty. loanDepot and your underwriters, I imagine you're talking about certainty that it's going to continue for 3 years into the future from that point.
That's right. And so really what you're talking about is, if you build in that 6-month historical perspective, you're talking 3.5 years of continuance minimum. And then it can change.
Right. All right. So what's the optimal time for someone to apply for financing?
I would say it's probably good to have a consultation with me early on if they're working with you and such, and you're trying to figure out what would this look like? What could this mortgage payment look like? And obviously we can't lock into an interest rate at that point. We don't have a signed divorce decree. And I would imagine a lot of the assets are still maybe going in that division process. So we're not quite sure where we're going to be. But at least I can often give some assurance and some comfort as to these are some of the options that you could be looking at. These are some of the things that you can do. A perfect example is going back to work. If they're going back to work and they've been in the workforce before they left to raise children, we look for 6 months on that. Well, that 6-month timeline of receipt of alimony and child support can also be accruing while they're back in the workplace. Mm-hmm. So when they apply with me, 6 months have gone by, I've got a work history, with pay stubs in a similar line of work. And I've got that income for child support and alimony. So it all kind of comes together. So probably the consultation, maybe when they're thinking about getting divorced, and then the application itself, I would say, is 6 months after the recorded divorce decree.
Mm-hmm. Okay, but they can, during that 6-month period, really set up their lives to maximize the approval of the loan.
That's exactly right. And I can give them some advice, things like not maxing out credit cards, there's certain things we can do to try to drive their credit scores up. Also, they can look at their credit beforehand and see what it looks like. How much credit is in their name? You brought up a great point, which is in many situations, one marital partner has the primary finances. There are sometimes the wife is not on some of these things. And so there's not a lot of credit history. Mm-hmm. So that's also very important, is building that credit history.
I see. I actually see the reverse, that sometimes the spouse doesn't know that their name is on a credit card being used by the other one.
Yeah.
And they find out that their credit has been impacted in ways they didn't expect.
Yeah. I've seen
You've seen
that
that
as
too.
well. Yes, I've seen both sides.
Yeah. The secret credit card swindle, and then constantly flipping credit cards to lower interest, and then you kind of lose track of who's on which one.
Exactly. And that's a big thing that we see a lot too, is this constant moving of money. And that can be very challenging because in my world, every dollar has to be accounted for. So there has to be a paper trail. So when money keeps changing accounts, or if credit cards keep getting rolled over, it can be a real challenge, because credit report's a snapshot in time. So it may be that this account was just opened up and now has a new balance on it of $6,000, and that account had $6,000 was transferred. Well, we're actually going to use both. So it's important that you try to kind of keep everything as calm as can be.
Oh, that's an interesting
from a financial standpoint.
So if you roll over a credit card balance from one to another during this maybe the 6-month period, for example, in the credit analysis for the loan application for mortgage, they're going to use both balances?
They may, depending on the timing of the credit report.
Oh.
Credit reports are often 30 days behind. What will
Yeah.
probably show up is the new card will show up as an inquiry, and we'll have to document what happened with that. But the old card shows up with the balance. So during that interim phase, we may have to debt them for both, because we can't see the payoff on the credit report unless sometimes we're able to get a credit update on certain things and see that it in fact was rolled over to another. But the other thing is that when you apply for new lines of credit, it creates a credit inquiry, which can impact your credit scores. So whether it's applying for a credit card, applying for a car loan, applying for furniture, if you do a lot of that the 6 months prior to, your credit score could be lower than what you thought it was when you come in, and that's not helpful either.
Yeah, there seems to be a general confusion about that. Just the inquiry can actually lower a credit score.
If there's enough of them, absolutely.
And what is enough, or what is too many?
So, for example, if you're looking for a new car and you apply within a week, and let's say there's 3 or 4 credit inquiries from different places, that's only going to be equal to like one inquiry, because it's understood that if you're applying for a car, you're looking around, and that's the impact will be minimal, I would guess. We'd still have to document the car loan, obviously. But if you stretch that out over a 6 or 12 month period, and every month you apply for a car loan, it's going to look like you are having trouble getting credit, and it's going to show up as numerous inquiries, which could impact your score. So the rule of thumb is when you're after you start talking to me, unless you're talking about a projected window a year out, don't apply for any new credit cards. Don't be late on anything you have as far as credit cards or any debt obligations, and just kind of try to keep money settled. Don't keep throwing it from one account to the other account, so forth and so on, because we have to track all of that.
All right. And what about closing credit cards? Does that impact the credit score?
That's a wonderful question, and the answer is absolutely yes.
Oh.
So I'm really glad you asked that, especially in the case where you've got joint credit cards, and I would think that oftentimes what makes common sense is let's close this. The challenge with that is, from a credit score strictly standpoint, the longer you have a credit history, the stronger that impact is on your credit score positively. So if you have a new card that you just opened up in the last year, and you had a joint card that was 12 years old, and you close that joint card, that's going to have a lot more of an impact, because now it just looks like you have a card you've only had credit for 1 year. This one is closed. So what you want to do is you want to try to leave that, if you can, leave that other card open, and maybe one party gets removed as an authorized user, or vice versa.
Mm.
But yeah, you want to try to do that. The longer the credit history, the stronger impact it is on your credit score.
Okay. And just getting back to qualifying for, let's in the refinance in our hypothetical situation with this wife who wants to stay in the marital home, what kind of credit ratios are commonly used now? Or debt to equity ratio, I guess it's called.
Right. So in the example that we're talking about, which would, assuming that we've got a $500,000 existing mortgage, $500,000 equity. When we do add that equity buyout, we're going to be at $750,000. So $750,000 on a single family home in our greater Boston area, is going to be considered a jumbo mortgage. And jumbo mortgages cut off at 43.00 debt to income. What that means is that for every dollar that ex-spouse is making gross, their total debts, including housing payment, principal and interest, taxes, insurance, as well as any other debts they're responsible for, credit cards, car loans, anything like that, that can be up to 43 cents on the dollar. And there's a very strict cutoff on that. Once you cross over that, there's lots of new lending laws that came out under the QM rule, qualified mortgage rule, and it's very, very strict. You really have to kind of bring it under that level.
Okay, so if this wife has to borrow $750,000 in order to stay in this house, I imagine there are several products that she could look at. One is interest only, which would mean that her payment's a little bit lower.
Now, right, that's true. However, the qualification on an interest-only mortgage is actually oftentimes stricter than it would be on a 30-year fixed. And the reason for that is because while an interest-only is more comfortable for that 7-year period, the principal and interest portion of that loan kicks in for about a 23-year period. So what you do is you take the full balance of that loan, assuming she's only paying that interest-only portion for the 7 years, and you amortize it over 23 years, based on what that adjusted rate probably would be at that time. So it can be, the underwriting is actually stricter on that, but from a personal standpoint, it can be a lot more comfortable.
Because the monthly payment is lower.
Exactly.
And it might be easier to qualify under that 43% ratio.
Exactly.
All right, so another option is an adjustable rate mortgage, but that's fixed for a period of time.
Right, that would be fully amortized, or even a fixed rate. You know, I find it's interesting. I find a lot of people having gone through a divorce, it's obviously a very emotional process. Having a fixed mortgage payment is somewhat comforting. Even though you think, I'm going to be out of this house in 7 years, at least you don't feel like, oh my gosh, my payment's going to change at the end of 7 years and it could go up, and then what am I going to do? I don't know. You know, at that point, my child support or alimony may be falling off or being reduced. So having that comfort of having that fixed payment can be helpful.
Yeah, well, I guess people don't know what the future will bring.
Exactly. Exactly.
There's uncertainty about that. Well, very interesting. Are you noticing any trends lately? I know the interest rates went up a little bit, but you know, it seems to me that the divorce business is pretty consistent. So people are coming to you for refinancing incident to a divorce. You're seeing a lot of that kind of work?
Yeah, we are seeing a fair amount of that. As far as interest rates go, I think interest rates, will probably rise over time. That seems to be the trend that we're seeing. But as far as the impact with divorce, we're usually able to help people work through it. It's understood that and again, by sitting down and speaking with me early, we can look at what's it going to cost, because maybe ultimately the decision is we need to sell the house.
Right.
I mean, and those are really frank conversations that you want to have early on, so that you can, as in doing your job, structure it accordingly.
Yeah. That's a difficult conversation. I have, a client right now where the house is valued at more than $1 million and they've got $600,000 of equity, and she can't qualify to buy him out.
Right.
So she's gonna have to sell. And it's a painful decision.
It is. And actually I can be somewhat helpful in that too, because, I guess half the time I'm a loan officer, half the time I'm a psychologist.
Yes.
I can understand a lot of the emotional impact, and I can often walk people through and say, let's look at this. I understand there's history there, but okay, what if you sold? What could you do with that money afterwards? Could you buy another property? Could you buy maybe a condominium and be mortgage free? Mm-hmm. What would that feel like? Mm-hmm. And so we can talk about those things. It's having those honest conversations early on that can help, I think, a lot, because it not only enables them to look at the financials, but it also enables them to see a little bit into the future. There's life after divorce, and what could it look like? If they do want to stay in the house, then we can try to look at that and see what's involved. And maybe, in the example we talked about, he's being bought out, but maybe if we delay that buyout until 7 years or 10 years out, and we just refinance the existing mortgage of $500,000, maybe that allows her to stay in the home for that period of time, and he gets his equity later.
Later, yeah.
And so that's that I
If
know.
the spouse
plays
is
in-
willing to wait, yes,
exactly,
that's right.
exactly.
Now, it's a great option if the spouse is willing to wait. But in the meantime, the spouse who's not living in the house has their credit impacted because they're still on an existing mortgage.
Exactly. So they're able to move on with their life if they can wait for their equity,
Yeah.
and move on with their life and buy another property themselves.
If they have enough income
if they
to
have enough
qualify for
income.
another mortgage.
Right, and assets. Obviously, they need a down payment,
Yeah.
and maybe it's a combination.
Mm-hmm.
Maybe it's a partial equity buyout.
Mm-hmm.
You know, I can't give you the full $250, but you know what? I can give you $50,000 or $100,000, and maybe that changes things a bit. So it's that type of back and forth where you and I might be working together along with your client to try to come up with a solution where everybody's going to win.
Right. Well, then you become a financial planner, right? A real estate planner.
There you go.
Right. All right. Is there anything else that you want to add to our circumstances today, for example?
No, I think that the most important thing is to get professional advice from someone like yourself, or speak with someone like me as early as possible. I think by building a strong team to help through a difficult situation, it can make all the difference in the world.
I absolutely agree with that.
There's so much emotions that are flying around when you have practitioners that deal with this every day, as you do and as I do. I think it can help a lot, and it can alleviate a lot of pain and suffering that can happen as a result of mistakes being made along the way.
Yeah. I could see having you as a valuable part of that team because there's almost always a marital home involved, and that's usually often the largest asset of the marriage. So doing some really good financial planning before the divorce agreement gets signed would be really helpful, so everybody knows where they stand.
It's been very interesting. I've had a fair amount of success actually handling both parties, both exes, because they like the approach that we take. It's more of a consultative approach, and not really looking at the emotion aspect of it, but saying, okay, let's look at the financial aspect. How can you both come out winning from this situation? What's going to, and it's worked out well.
Well, you hit on something important. Both of them have to feel like they're winning, or they've won, or they neither have lost, at least.
Exactly.
Right?
Exactly.
Brad, this has been great. I really appreciate it, and I'm going to take some of the advice, some of the things I learned today, and use them in my negotiations. I appreciate that for myself, and I hope your listeners have learned something important today too. So I've been speaking to Brad Avergon, and he's at loanDepot, helping people finance real estate. So Brad, how can our listeners reach you?
The best way to reach me is probably via my cell phone, and that's 978-375-5531. You can also email me at Avergon, so it's B-A-V as in Victor, E-R-G-O-N at loanDepot.com. I myself am licensed in New Hampshire and Rhode Island and Massachusetts, but through my company, we can lend all over the country.
Oh, that's good to know.
That's helpful.
Nationwide financial services.
Absolutely.
Thank you, Brad.
You're very welcome.
If you'd like more information about the topics covered in our podcast, please contact us at Grossman & Associates. You'll find a competent and experienced team of compassionate, responsive, and innovative legal professionals. Email me at hindell@grossmanltd.com. My first name is spelled Hindell, or call us at 617-969-0069. Thank you for listening.